The coup in Myanmar is bad news for everyone, including China. The military has moved to arrest civilian politicians this week, including Nobel laureate Aung San Suu Kyi, after an election the army said was flawed. It has declared a state of emergency that is to last a year. This may mark the end of an experiment in democratic liberalization that has lasted less than a decade. It will also further discourage foreign investor enthusiasm for what was once one of Asia's hottest emerging markets, a place that attracted some $37 billion in FDI as companies like Japan's Kirin and Telenor invested in telecommunications and beer, before the government engaged in what the United Nations described as ethnic cleansing against the Muslim Rohingya minority. The United Nations and Western democracies have condemned the move. Beijing's response has been a little bit more circumspect. If everyone else ejects, Chinese capital will be the only money in town, and an isolated Myanmar will be more dependent on Beijing, as it was before. On the other hand, the Myanmar military is not really a friend of Beijing's. It suspects China of supporting ethnic insurrections along the shared border, and it doesn't have a particularly good record of economic management either. It's possible the junta will let Chinese companies restart work on the stalled dam they've been trying to build for years. It's also perhaps will boost demand for Chinese security devices and services. But outside of that, the state of emergency is likely to cool demand for more peaceful Chinese applications, products, and services, including e-commerce, fintech, fashion, and deter private investment into manufacturing outsourcing and the like. The Chinese Communist Party says its authoritarian approach is generally better at delivering economic growth, but it might nevertheless miss this particular democracy once it's gone.